Welcome back to another video. Today we got a bunch of stuff. We got a bunch of tabs here that I want you guys to pay attention to. So this stuff is what I'm going to be looking at. I'm recording this on a Sunday, but I just wanted to let you guys know what I'm going to be doing come this Monday to look for some value. So the first thing I wanted to start you guys out with is this article from April 3rd, 2020. So this is right after the pandemic started. And this person, Richard Bernstein, says, no, this isn't the stock market bottom. And without belaboring the point, as we know, it was the stock market bottom. And we've seen a massive run up ever since that stock market bottom. I want to just bring a couple things to you guys' attention, basically about what I think about this next stock market bottom, some indicators that happened before the last two stock market bottoms, and where I'm looking for value, what tools I'm using. So anyways, obviously we know this guy was wrong. It looks like he pulled his portfolio into value and defense. So he basically missed out on a very long bull run, very big bull run, which if you bought into, which I was buying into, you made a lot of money. So anyways, fear, what do they say? Scared money don't make money. Let's go next tab. Next tab, this is a Fidelity study that shows what would have happened if you stayed invested versus missing the best 5 days in the S&P 500. So we have a hypothetical $10,000 investment in the S&P 500 index. This is from 1980 until 2018. As we see here, if you would have stayed fully invested, you would have turned your $10,000 into $708,000. If you missed just the best 5 days over the period of 38 years, that would cut you down to $458,000. And a lot of the best days tend to happen right after stock market bottoms. So in other words, a lot of the best days tend to happen right after people are the most afraid. So when people are getting afraid, you should be getting excited. I know that's a common saying, but you absolutely should be getting excited because you have the information on your side and you know that if you just stay invested and that if you just continue to buy towards that bottom, you're going to make more money than everybody else. So I just wanted to show you guys that. Look, missing the best 50 days, you're going all the way down to $62,000. You're only making 50 grand over 30 years in that situation. You're not going to be able to retire off of that. You've just worked for 38 years and your investment has only made you 52 grand there. So it's a huge difference. Next tab here. So what I wanted to tell you guys is, like we said, scared money don't make money. But if you do have to store some cash somewhere, which cash is going to become trash if we see a bunch of inflation, you can get this H.M. Bradley account, which it pays you 3% interest. You guys can see my interest payments here. I've shown this account before, but this is a great account. I've been using it. You have to direct deposit into it each month, but I'm going to leave a link down in the description below, as well as other links where you can make some money. H.M. Bradley, you can get referred over here, and you can get resets on your savings account, which basically means that if you get taken out of your savings tier, which your savings tier, tier 1 is 20% saved of what you deposit, you can get a reset on your savings tier. So if you want to take advantage of that and get a 3% savings account, check out the links down below. Also, I have Robinhood links. I have credit card sign up links. I've got Webull links down there. There's plenty of money to be made down there in my description. So I always plug it, but it's not just for me. It's also for you guys. You guys can make a little bit of money down there. So next thing I want to bring you guys' attention to is crude oil prices. So crude oil prices and inflation. As we see, whenever we see inflation, deflation, we see oil prices go up, oil prices go down. We see deflation, oil prices go down. We see inflation, oil prices go up. When we saw the beginning of the pandemic, oil prices went way down as the demand went back down. But now what we're seeing more recently is oil prices are going back up sharply and oil stocks are going back up. So this is what we said in the last video of 4 stocks I'm buying. I'm buying into the energy sector because, like I said, I don't want to have individual stock risk with the oil sector because, in my humble opinion, the oil sector is something that is going to be declining over time. However, it looks like a good investment right now with the inflationary policies that the Federal Reserve is putting into place. So that's something that I want people to pay attention to, is crude oil prices and the fact that with inflation, crude oil benefits, as well as other companies that benefit from inflation and higher interest rates. So we're talking banks. Banks benefit from higher interest rates. That's something that I want people to look at as well, financials. When banks can charge higher interest rates, they can make a little bit more money, they can get better margins. So banks are something to look into as well. Companies that sell commodities that are likely to go up in price, people that sell food, restaurants, Walmarts, things like that. Who is going to have the pricing power? That's what, if we see inflation, that's who is going to do well. People who have pricing power, people who have ability to raise prices as costs go up. We're going to potentially see labor costs go up if they introduce this new minimum wage. If labor costs go up, we're going to need to be in businesses that can raise the prices of their goods, of their services. Because if you don't have that pricing power, if your industry ends up getting outsourced to another country, your business is not going to do well. Okay, so we went over cash is garbage. We went over H.M. Bradley. Next thing I want to talk about is thinking about real estate. If you have the money to put down in real estate, or you can figure out how to do a zero money down, I actually have a video about how to get into a real estate deal with low to no money down. Think about real estate, because as the prices go up, real estate tends to go up with it. It's an inflation hedge in that way. In addition, your debt is going to be easier to pay off if we see inflation. You're paying it back with decreased value dollars. Rental property. So once again, within the real estate industry, rental property, you're able to raise the rents as prices of things go up. So that is a good hedge against inflation as well. So if we're seeing inflation, real estate and rental properties are going to be a good thing, or just owning where you live is going to be a good thing. I've got a video about how to get that for free or for cheap. So next thing, let's talk about growth stocks. So why are growth stocks selling off? The reason why growth stocks are selling off is because a lot of growth stocks aren't necessarily growing based on the cash that they have. They're growing based on borrowed cash. They're growing based on equity. So if money becomes more expensive, then it's going to be harder for people to come by equity. So if you're fueling your growth engine with debt, it's going to be more expensive once those prices of money start going up, right? Interest rates start going up. So that's why we're seeing a hit in growth stock. Next thing I wanted to talk to you guys was about a couple of stock screeners that I am using. Macro Trends. This one is pretty good. You can go in here and go into their stock screener tool, and you can start messing with a bunch of these things. Let's say that you wanted companies that are selling at a PE ratio less than the industry average. So I've got it set to a maximum of 25 right now. So we see Exxon coming up. We see Comcast coming up. We see Verizon coming up. Buffett just bought into Verizon. We see AT&T. We see a lot of very high dividend paying stocks, right? We see Cisco, which Cisco tends to be a very cheap company as of late. Cisco makes a lot of money and they sell for really cheap. You could make it even more inexpensive. We see Pfizer down there, AbbVie, another one that Buffett's buying into. We could take it down to 15, right? Now we're getting 15 price to earnings ratio. You see Morgan Stanley, Boeing down here, they're getting beat up. We see Exxon, Intel, Verizon again. Okay, so we can change this. Let's say that we want only large companies. So let's say that we want only 10 billion or more in market cap. Okay, so then we could do even more. Let's say 50 billion or more. This is a good stock screener. This is something that you can generally, let's say you just wanted to find something cheap, or you wanted to find a high dividend yielding stock. Let's say you wanted only 4% dividend yields. It's just a good way to just look for companies. Basically, that's what I wanted to show you there. Macro Trends, go into their stock screener. So free cash flows. I wanted to give you guys basically the definition of free cash flows, and then show you guys on Macro Trends what I'm liking about a stock like Church & Dwight. It was a stock that I did another video about recently. So free cash flow. Let's go down to the takeaways here. Free cash flow represents the cash available for a company to pay and repay creditors and pay dividends and interest to investors. So essentially, free cash flow is the money that's available to you as an investor. So let's go over here to Church & Dwight. These are the people that sell Trojan condoms. They sell very common household brands like Arm & Hammer, things like that. So let's look at their trailing 12 months free cash flow per share. We see a nice upward trend here, right? So this is your money if you buy into this company. This is your money, the free cash flow right here. So how you do that is you go over here, you type in, well, for this stock, CHD, free cash flow. Okay, price to free cash flow ratio. You come down here and you look at the trailing 12 months free cash flow per share. So that's been trending up. I like that. This is not the end all be all, but that's just a good sign, right? When the money that's available to you is going up. Next thing, magic formula investing. I'm going to show you guys basically what magic formula investing is, and then I'm going to show you guys the stock screener, and it just brings up some pretty cheap companies. So stock screening with magic formula investing. So include stocks with market capitalization above 50 million or 100 million or 200 million. Exclude financial and utility stocks. Exclude foreign companies. Determine companies' earnings yield, which is EBIT over enterprise value. Determine companies' return on capital, which is EBIT over net fixed assets plus working capital. Based on steps 1 through 5, rank the results according to earnings yield and return on capital. Rank as percentages. 7. Invest in the 20 to 30 highest ranked companies, accumulating 2 to 3 positions per month over a 12-month period. Rebalance portfolio once per year, selling the losers 51 weeks after purchase for tax purposes, and winners 53 weeks after purchase. This is for tax purposes. Only use this strategy for the long term. Use it over a period of 5 years. So this strategy was generated by Joel Greenblatt. He is a hedge fund manager and Columbia University professor. He saw a 24% return using this strategy, and it's basically a lot of these strategies, if you back test them, they're really good, but this strategy is much different because it's just screening for companies that are making a lot of money and that are selling for cheap. So this strategy is obviously not an end all be all, but it does find companies that are making a lot of money and that don't have a lot of debt relative to what they're making, and they're selling for cheap. So anyways, you can go in here, you have to sign up for magicformulainvesting.com. And basically I put in here market capitalization minimum 50 million. And 50 stocks. It brings up, basically, according to his categories, the stocks that are making the most money and selling for the cheapest. All right, we see Altria here. We see Cisco, okay, selling for cheap. These stocks are all cheap on here, and they're making a lot of money. So that's a good place to start, and then you can go in. We see Quest Diagnostics. They've been outperforming. Turtle Beach, they outperformed for a while. Weight Watchers International, they outperformed for a while. So these are generally good places to start, but let's go to the next thing. Let's go into the volatility index. So VIX, the VIX tends to spike just before the market bottoms out. So as we look right here, we see December 17th, the VIX spiked at 30.11. And right after that, the market hit a bottom December 24th. This was back when there was the trade war going on. The VIX spiked right before the market hit a bottom. So then the market went and trailed off and hit a bottom. And over here, this is right when COVID happened. The VIX spiked March 16th. So we had a really volatile trading day on March 16th. And then we hit a bottom right after that. I believe it was on March 23rd. That article was written somewhere over here where they said that it wasn't a bottom. Once again, over here, we see the VIX spike at October 26th. Closely after that, we hit a market bottom. Right now, we're spiking back up into the 28.57 range, so that VIX is going back up into this 30 range where we tend to see a market bottom. So in my opinion, we could be getting close to a market bottom, even though we're still really overpriced here. So who knows? Maybe the VIX comes up here. Maybe the VIX stops right here. Nobody really knows. But one thing to pay attention to is just what the VIX is doing. Typically, after it spikes, we see a market bottom. So next thing to pay attention to, fear versus greed index. So there's a couple different things that the fear versus greed index measures. One is junk bond demand. Right now, we've got extreme greed in the junk bond demand. Right now, junk bonds are very close to traditional yields. There's a lot of demand on junk bonds because you can't really find very much yield anywhere. So stock price strength, we're still seeing extreme greed, right? The stock market is still pretty high. The multiples are still really high. Okay, market volatility, we're seeing neutral. But recently we were at extreme fear, and this rating changed from February 25th. So we saw that rebound, right? There's not as much fear out in the market. So we could be seeing a turnaround, who knows? Okay, stock price breadth. So basically this is just measuring volume. So how many stocks are actually being traded? Market momentum, we are starting to see this go from fear to neutral. Okay, so safe haven demand, we are seeing this going from extreme fear to fear. We saw that rebound in the NASDAQ. and put and call options, people are still shorting the market. So that is extreme fear right now. This changed from greed January 15th. So if we had to judge where we're at right now in general, we're at about neutral. So we are not yet in extreme fear according to this index. And usually when we see extreme fear, I believe we saw a number 9. We saw number 9 1 year ago, and that was right before the market bottom. And the last thing that I want to show you guys, which is something that I've showed you guys in other videos, is what I'm planning to do if we start to get into that fear scenario, if we start to get into that stock market crash scenario, right? So right now I'm looking at value because we're in the neutral to greed area. But if we start to see a lot of fear in the market, I'm going to go back into these high conviction growth names. So we're looking at Tesla, Beyond Meat, Uber, Disney, Altria. I put them in there because they are a nice dividend play. Google, Visa, Dropbox, Facebook, Microsoft, Apple, Amazon, Adobe, Costco, Netflix, AMD, Chipotle, Chegg, and Nvidia. The reason why I put all of these growth type companies over here outside of my retirement accounts is because if you don't sell, you don't pay taxes. So that's the reason why these are over here. I have high conviction in these stocks. I think they'll be great companies over the long term. If we start to see great prices, then I'm gonna start putting money into this. But anyways, hopefully you guys liked this video. If you did, make sure you give it a thumbs up. Hit the links down below if you guys want to make some money, and I'll see you guys in the next video.